Imagine a single microscopic speck of dust.
Right.
Like, in your living room, it's just a minor annoyance. You might eventually get around to vacuuming it up.
Yeah, if you're lucky.
Exactly. But if you take that exact same speck of dust and put it inside a multi-billion-dollar semiconductor fabrication plant,
Oh, that's game over.
it is. These are the exact facilities building the microchips that are literally powering the entire global AI revolution right now. And in there, that single speck of dust is catastrophic.
It really is. I mean, if it lands on a silicon wafer during the lithography process, it could just instantly destroy hundreds of thousands of dollars worth of advanced tech.
Yeah, it's mind-blowing. You're dealing with environments where the margin for error is, well, literally microscopic.
Utterly microscopic.
So today on this deep dive, we are looking at a company that is quietly, but very aggressively, buying up the rights to mop the floors, filter the air, and manage these highly sensitive clean rooms of the AI revolution.
It's such a fascinating pivot.
It really is. We are tearing into the fiscal first quarter 2026 results of ABM Industries. And look, if you are looking at your portfolio right now and you're seeing legacy commercial real estate bleeding out, you might be wondering why on earth we're dedicating an entire deep dive to a facilities management company.
Right. Like, why talk about the janitors?
Exactly.
Okay.
But you are about to see how the mechanics of physical infrastructure tell the actual real story of the global economy.
Yeah, and the tendency for the market to just miscategorize businesses, that is exactly where the real alpha lives for you as an investor.
Oh, 100%.
I mean, if you just pull up a standard stock screener, ABM is going to look like this legacy janitorial and parking management stock. People just think of the folks emptying the trash cans in a midtown Manhattan office building.
Which, to be fair, they do.
They do.
Right.
But when you actually unpack the revenue streams, you realize that ABM is functioning as this massive, real-time, macroeconomic bellwether. They have over 100,000 employees operating across just an incredibly diverse set of critical verticals. So when we look at their performance, we're getting a direct, unfiltered pulse on the actual physical volume of aviation travel.
Which is huge right now.
Massive. And we're seeing the unvarnished reality of blue-collar labor availability in this country. And perhaps most crucially for this specific quarter, we're tracking the physical infrastructure build-out required to support the semiconductor and AI sectors.
Yeah, so when this management team speaks, you aren't just hearing about cleaning contracts. You're hearing the collective hum of the American economy's physical infrastructure.
That's a great way to put it.
Well, I've been turning these earnings over in my head all morning, and the best way I can frame the dynamic of this specific quarter is to picture a high-performance vehicle.
Okay, I like where this is going.
So the engine, which in this case represents their organic customer demand, it's absolutely roaring. It's tuned perfectly, and it's pulling hard.
Right.
But the suspension of this car just took a massive hit from a weather-induced pothole.
Oh, a brutal hit.
Brutal, causing a severely bumpy ride for the bottom line. So the vehicle is still moving incredibly fast, but the passengers in the back seat definitely felt that jolt.
They felt it in their teeth, yeah.
Exactly. So let's get straight into the results snapshot and look at these top-line triumphs versus the bottom-line bruises. The core financial metrics show revenue coming in at $2.2 billion for the quarter.
Which is solid.
Yeah, that's a 6.1% year-over-year increase. But the number that really demands attention is a 5.5% organic growth rate.
Yeah, we have to isolate why that 5.5% organic growth metric is so vital.
Please do.
Because top-line revenue growth, I mean, it can be easily manipulated if a management team just wants to go out and buy up smaller competitors.
Right. You just spend some cash, bolt on some revenue, and suddenly the headline number looks amazing.
Exactly. But organic growth strips out all the acquisitions. It strips out the accounting noise. It shows the core existing business expanding rapidly, purely based on market demand.
And their ability to actually win competitive bids.
Right. And a 5.5% organic growth rate for a company of this immense scale operating in the physical services sector. That is an exceptional print.
It really proves that the capital they've deployed over the last few years into expanding their sales resources, acquiring specialized technical talent, repositioning the brand, it's genuinely paying off in the real world.
It absolutely is.
But here is where the vehicle hits the pothole, right?
Yeah.
And where I imagine a lot of analysts started asking some really hard questions on the earnings call. The profitability metrics tell a fundamentally different story.
Yeah, this is the bumpy part.
Adjusted net income landed at $50.4 million, which translates to 0.83 cents per diluted share.
Right.
Now, if you compare that directly to the prior year's first quarter, they were at $55.3 million, or 1.87 per share. So despite adding all that new revenue, the actual profit stepped down.
Which nobody likes to see.
No. And we see the exact same dynamic with adjusted EBITDA. That came in at $117.8 million, down slightly from the $120.6 million we saw last year. So surging revenues, but shrinking profits.
Yeah.
If I'm an experienced investor looking at a massive services business, margin compression is usually a glaring red flag. Like, where is the leak in the plumbing here?
Well, the leak is highly localized, which is why the initial panic reaction you might see from a headline algorithm is just misplaced here.
Okay, so it's not a systemic issue.
No, we can isolate the primary drag on earnings almost entirely to a single segment, the Technical Solutions segment, which management refers to as ATS.
Got it.
There is an approximate 5-cent earnings per share penalty stemming directly from this one division. And the primary drivers there were severe project timing delays, heavily exacerbated by extreme winter weather events.
The weather.
Yeah, and we are going to drill down into the very specific and frankly brutal mechanics of how weather destroys margins in technical services shortly. But the key takeaway for you right now is that this is not a systemic rot across the enterprise.
Okay, but I have to aggressively challenge the premise that investors shouldn't be concerned. I mean, a miss is a miss. If organic growth is hitting 5.5%, which, by the way, is the best organic acceleration we've seen from them since that massive post-pandemic bounce all the way back in the fourth quarter of 2022.
Right. It's a great number.
So why didn't that operating leverage flow through to the bottom line? In a typical business model, let's say a software company, when revenue surges past your fixed cost base, your margins expand beautifully.
They expand effortlessly, yeah.
Exactly. So why did this isolated pothole completely neutralize the roaring engine of the entire enterprise?
Okay, so here's the thing. You are applying the operating leverage model of a software company to a physical, huge capital-intensive services business. And those two mechanisms operate in completely different universes.
Fair enough, but explain the difference for this specific model.
Well, in software, the cost to replicate your product and sell it to the 10,000th customer is essentially zero.
Right. It's just hitting copy-paste on some code.
Exactly. But in facilities management and technical services, your variable costs, specifically the wages of your labor force and the physical materials required for the job, they scale almost one-to-one with your revenue growth, at least initially.
Oh, because every new building requires new humans to clean it.
Right. You do not get automatic operating leverage just by signing a new contract. You have to aggressively engineer that efficiency into the daily operations over a long period of time.
Okay, I see.
To understand why that operating leverage didn't materialize universally across the board this quarter, we really have to tear apart the unit economics of each specific operating segment.
Let's do it.
We should start by looking at the areas where the growth was just unassailable.
Yeah, let's tear into the aviation segment first. This division grew a massive 10% organically, pushing revenue to nearly $298 million for the quarter alone.
It's a staggering number for physical services.
It is. Management cited highly resilient TSA checkpoint passenger volumes and the deployment of massive, multi-year FAA terminal modernization programs as the primary catalysts.
Yeah, and aviation right now is just a masterclass in structural, long-term macroeconomic tailwinds.
How so?
Well, for the last couple of years, the market narrative has been really focused on the post-COVID travel normalization bump, like people getting back on planes.
Right, revenge travel.
Exactly. But we are completely past that phase of the economic cycle. What you're witnessing in this 10% growth metric is the actual physical deployment of generational infrastructure spending.
So this is concrete being poured, not just people going to Cancun.
Yes. Airports across the United States are currently undergoing massive, multi-billion-dollar capital projects. They're expanding concourses, upgrading baggage handling systems, overhauling security checkpoints.
And all of that requires service.
Every time an airport expands its physical footprint, it requires a commensurate increase in facility services. You literally just need more people to manage the bigger space. Furthermore, ABM just secured a gargantuan passenger services contract at Heathrow Airport in London.
Oh, wow, Heathrow.
Yeah, and that specific contract is slated to begin its operational ramp-up in the second quarter.
You know, the mechanics of securing a contract at a facility like Heathrow are mind-boggling when you really think about it.
It's basically a small country.
Literally. Heathrow isn't just an airport. It is essentially a sovereign, mid-sized city operating at maximum capacity 24 hours a day. When ABM locks in a contract there, that revenue becomes incredibly sticky.
Because the switching costs are absurd.
Astronomically high. Airports do not change their core service providers on a whim. Think about the logistics of just securing security clearances and badging for a new workforce of 5,000 people.
It would completely paralyze the airport's operations.
Yeah, they'd have to shut down terminals just to get the new janitors badged. So when ABM lands Heathrow, it acts as a massive, immovable revenue anchor for the rest of the fiscal year and beyond.
Exactly.
That 10% growth is a phenomenal indicator of global travel health. But I want to shift our focus to the manufacturing and distribution segment, or M&D. They posted 7% growth, reaching $422.3 million.
Another really strong top-line print.
Yeah, and management explicitly, very deliberately, pointed to recent contract wins in the technology sector as the engine for this growth.
The tech sector tailwinds are undeniable.
Yeah.
But this specific segment perfectly answers your earlier challenge about why operating leverage didn't magically appear on the bottom line.
Okay, bring it back to the margin compression.
Right. Because despite driving 7% top-line revenue growth in M&D, the actual operating margins in this segment compressed. They dropped down to 8.6% for the quarter, compared to a very healthy 10% in the prior year.
And see, this is the exact math that drives retail investors crazy.
Oh, I know.
They win massive, high-profile contracts with premium technology clients. They grow the revenue by 7%, but their profitability drops by 140 basis points. Explain the mechanical breakdown here.
So the mechanical breakdown comes down to a concept we refer to as the vintage of the contract portfolio.
A vintage, like wine.
Sort of, yeah. When ABM goes out into the market and wins a massive, highly competitive new contract, especially if they are bidding against fierce rivals to land a premium blue-chip tech client, the initial margin profile of that contract is almost always structurally lower in year one.
Okay, let me test an analogy here. It sounds remarkably similar to the legacy business model of a telecom company.
How so?
Like, a major cell phone provider will gladly subsidize the cost of a brand new $1,000 smartphone. They will practically give it to you for free, taking a massive margin hit up front, specifically to lock you into a highly punitive, multi-year service contract. They know the initial transaction is mathematically negative, but the lifetime value of that incredibly sticky recurring monthly revenue makes it a brilliant trade. Is ABM executing a similar playbook? Like, are they intentionally taking lower initial margins just to get their foot in the door with these prying tech clients?
The telecom analogy gets you halfway there, but it breaks down on one critical variable,
Which is
the nature of human labor. A telecom company hands you a piece of hardware, locks you into a contract, and largely walks away. The margin expansion is purely passive. You just pay the bill every month.
right.
ABM, on the other hand, has to physically send hundreds of human beings into that technology facility every single day. So the margin expansion is not passive at all. It is a daily, grueling operational grind.
Oh, I see. They don't just sit back and collect checks.
No, not at all. ABM aggressively bids to win the prime real estate. Once they are physically inside the facility, providing the base level of required service, they initiate a highly rigorous long-term strategy of margin engineering.
How do they do that?
They force those margins upward over the life of the contract via two very specific levers. First, they cross-sell higher-margin auxiliary services.
Okay.
Once you are trusted to clean the floors, you pitch the client on managing the parking garage, then servicing the HVAC system, then maintaining the electrical grid.
Ah, land and expand.
Exactly. And second, they deploy intense labor optimization. During the first few months of a contract, labor routing is inherently inefficient.
Because they don't know the building yet.
Right. But as ABM's management learns the exact physical layout of the client's facility, they figure out how to route their staff faster. They deploy proprietary tech to track workflows, and they structurally reduce their direct labor costs.
That makes total sense.
Yeah, so that 140 basis point margin compression in the M&D segment is absolutely not a sign of operational failure. It's simply the mathematical reality of absorbing a very large cohort of newly won vintage contracts that require time to mature into higher profitability.
Okay, that reframes the entire margin compression narrative for me. It is literally just the upfront cost of acquiring prime long-term revenue.
Exactly.
But then we pivot to the education segment, and the script completely flips upside down. Education delivered what I can only describe as an absolute margin miracle this quarter.
It was wild.
The revenue in education grew by a very modest, almost boring 2%, landing at $228.7 million. But the operating profit in that exact same segment skyrocketed by an astonishing 54%, hitting $21.6 million.
Which is just a massive jump.
It pushed their operating margins up by an incredible 320 basis points to reach 9.4%. I need you to explain the physics of this to me. How on earth does a 2% increase in top-line revenue mathematically generate a 54% explosion in profit?
It's a combination of absolutely stellar operational execution by the management team and honestly a highly fascinating, entirely unpredictable weather quirk.
Okay, start with the operational side.
On the operational side, we have to look at how they manage inflation through contract escalators. In a macroeconomic environment where the cost of cleaning supplies, equipment, and baseline wages are all creeping up, ABM has to successfully trigger the pricing escalators embedded in their legacy contracts.
To pass those costs onto the schools?
Yes, to pass those rising costs onto the school districts and universities. An escalator works by tying the contract price directly to a metric like the Consumer Price Index. If inflation hits 4%, the contract automatically allows ABM to bill the school district 4% more.
Right.
But here is the operational alpha. If ABM can aggressively manage their internal costs so that their actual expenses only rise by 2%, while they are billing the client 4% more, that differential flows entirely, purely to the bottom line profit.
Oh, wow.
And they executed that escalation management flawlessly this quarter.
Okay, so that's the operational side. But the weather quirk is what truly exposes the microeconomic weirdness of physical services, doesn't it?
It really does.
We all saw the severe winter weather systems that completely paralyzed the large swaths of the country during this quarter. Massive snowstorms, ice, the works.
And when a severe winter storm hits a municipality, the first thing that happens is the school districts close. They call it a snow day.
Right, everyone stays home.
And here's the mechanical impact of a snow day for ABM. When the local high school or university campus is closed, ABM does not need to deploy its temporary, daily, hourly labor force to clean the cafeterias, empty the trash, or manage the athletic facilities for that specific day.
Oh, I see where this is going.
Yeah. The revenue they collect from the school district is often fixed on a monthly basis, but their direct labor costs plummet immediately because they aren't paying hourly wages for shifts that didn't happen.
That is wild.
Management actually quantified this anomaly on the call. They noted that these weather-induced school closures padded the education segment's margins by roughly 50 basis points in the quarter.
So the blizzard literally generated free cash flow for them in the education segment because they didn't have to cut checks to hourly workers when the buildings were locked.
Basically, yes.
That is an incredible detail. But this brings us to the ultimate painful irony of the quarter. The exact same severe weather pattern that artificially padded the margins in education absolutely devastated the profitability of the Technical Solutions, or ATS, segment.
Yeah, the duality of how macroeconomic factors impact different types of labor is staggering here.
Let's look at the ATS stumble. Technical Solutions revenue was actually up 14% year over year, with a very strong 7% of that being pure organic growth.
Which is fantastic growth.
Yeah, and this top-line momentum is being driven by their exposure to mission-critical facilities and the data center market. I mean, the demand for keeping massive server farms operational, perfectly cooled, and uninterruptedly powered is insatiable right now.
Completely insatiable.
However, the operating margins in the ATS segment completely collapsed. They plummeted to 3.7% in Q1, down from a highly profitable 8.2% in the prior year.
Yeah, dropping from 8.2% to 3.7% is a massive, violent contraction.
You mentioned earlier that there was a 5-cent earnings per share penalty isolated entirely within this segment. Walk us through the specific mechanics of this $20 million pothole. Like, what actually broke?
Well, the core failure point was centered in their microgrid business.
Okay, explain what a microgrid is for those who might not know.
Sure. A microgrid is essentially a localized, self-sufficient energy system that can disconnect from the traditional grid and operate autonomously. It's something data centers are desperately building right now to secure their power supply.
Because the main grid can't handle the AI loads.
Exactly. So the severe winter weather didn't just slow down the construction activity on these complex projects. In one highly specific case, a major customer completely suspended all construction operations during the quarter.
Completely suspended.
Yeah, because you physically cannot pour specialized concrete or run high-voltage electrical lines in the middle of an ice storm.
Right. That makes sense.
And because the revenue in the ATS segment is largely project-based and recognized strictly based on hitting specific completion milestones, this construction suspension abruptly delayed approximately $20 million in revenue recognition.
Wow.
That $20 million was effectively erased from Q1 and pushed out into the nebulous future.
Okay. I understand that the revenue is delayed, not permanently destroyed. The data center still needs the microgrid built.
Right.
But I need you to explain the mechanical brutality of this margin crush. If the physical construction project is paused because the site is covered in ice, shouldn't the costs associated with that project pause as well?
You would think so.
Right. Like, why did the margins collapse so violently if nothing was happening?
Well, in a purely theoretical, perfectly frictionless economic model, yes, the cost would pause. But in the brutal reality of technical services, you are dealing with the unforgiving mechanics of what we call sticky costs.
Sticky costs.
Yes, you have to look at the specific nature of the workforce here. The people operating in the ATS segment are absolutely not the temporary, hourly workers that you can just tell to stay home unpaid on a snow day like we saw in the education segment.
Okay, who are they?
We are talking about highly skilled, heavily credentialed technical engineers, master electricians, and specialized project managers. The labor market for master electricians who actually understand data center microgrids is incredibly tight right now.
Oh, so they have a ton of leverage.
Immense leverage. If you try to furlough or lay off your highly skilled technical workforce just because it is snowing for 2 weeks, they will be hired by your closest competitor within 10 minutes.
Oh, wow. So you're trapped.
You are. You do not fire them. You absorb the cost. You keep them on the payroll. You pay them their full salary to essentially sit in a truck or a warm office. You maintain your supply chain readiness.
And your massive fixed overhead remains completely intact while the revenue recognition drops to absolute zero.
Exactly.
So the mathematical denominator in the margin calculation, the revenue shrinks drastically because no milestones are being hit, but the numerator, the massive payroll costs for these specialized engineers, remains essentially flat.
It's a recipe for short-term profitability annihilation.
It is the definition of negative operating leverage.
And there is a secondary structural factor compounding the pain here too, the service mix.
Tell me about the mix.
The margin profile of the ATS segment fluctuates heavily depending on what specific type of work is being completed in any given quarter. Last year, the first quarter featured a significantly higher volume of engineering-heavy consulting work.
And I'm guessing that pays better.
Oh, much better. Engineering design work carries structurally massively higher margins than the physical boots-on-the-ground installation or maintenance service work.
Right.
This quarter, the mix naturally shifted away from that high-margin engineering phase and into the lower-margin physical service phase. So you had an unfavorable year-over-year margin comparison baked in before the first snowflake even fell.
And then it compounded catastrophically with the weather delays.
Exactly.
So we have sticky payroll costs, bleeding cash during a massive weather delay, compounded by an unfavorable mix of lower margin physical service work versus higher margin engineering work. It is literally an operational perfect storm.
That's the perfect phrase for it.
But management was incredibly adamant on the earnings call that this is purely a timing issue, not a fundamental demand destruction issue. Like, they are aggressively forecasting that this delayed $20 million will be recognized later in the fiscal year.
Yes. And this exact point is where we transition from analyzing past data into engaging in pure forecasting. And it requires a significant degree of faith in historical patterns.
It's a lot of faith.
The entire thesis of ABM hitting its full-year earnings guidance relies absolutely on this historical second-half snapback materializing perfectly. Management went out of their way to point out that historically, if you look over the last 3 years, roughly 2/3 of the ATS segment's total operating profit is delivered in the second half of the year.
Wait, 2/3?
Yeah. They typically see a massive 350 basis point improvement in margins as they move from the first half into the second half.
Hold on. I am going to push back incredibly hard on this narrative.
Go for it.
They are essentially telling investors, trust the historical seasonality, the construction projects will magically resume at full speed in the spring and summer, the high-margin engineering mix will miraculously normalize, and the profits will just flood back into the income statement.
That is the pitch.
That requires a monumental leap of faith from the market. They are telling us that these highly paid engineers who were sitting idle during the snowstorms are going to somehow double their output in the summer to catch up.
Yeah, it's a bold claim.
It sounds exactly like a management team trying to artificially maintain their guidance to protect their annual bonuses. How is that physically possible without incurring massive punitive overtime costs that will just crush the margins all over again in the third quarter?
Look, your skepticism is entirely warranted, and it is the exact debate happening on institutional trading desks right now.
So what's management's defense?
Their counterargument is that their project backlog is so robust and the demand from these data center clients is so inelastic that they can sequence the delayed work efficiently without blowing out their overtime budgets. They are banking on the sheer volume of high-margin work returning to dilute the fixed costs. Whether they can execute that flawlessly is the single biggest risk to the stock right now.
I'll say.
But while we are analyzing how management makes tough, high-stakes decisions, we really need to pivot entirely to the business and industry segment, the B&I division.
Oh, yes.
This is where we see a level of strategic, ruthless capital discipline that is exceedingly rare in public markets.
Right. B&I is their behemoth segment. It is their largest division, generating $1.1 billion in revenue just in this single quarter, posting 4% growth.
Massive.
But management issued a very stark, very clear warning for the back half of the year regarding this segment. They explicitly stated that top-line growth in B&I is going to moderate significantly.
And the reason is fascinating.
Because they are intentionally, voluntarily exiting a massive contract with Transport for London, or TfL. To put the scale of this in perspective, this single contract represents approximately $70 million in annual revenue.
Yeah, willingly walking away from $70 million in top-line revenue is an incredibly difficult decision for any executive team.
It's unheard of.
It really is. Let's delve deeply into the analysis of good revenue versus bad revenue, because this is just a masterclass in capital discipline. Do you recall our earlier discussion about the M&D segment, where we established that ABM will frequently take on lower-margin vintage contracts with the explicit expectation of engineering them to higher profitability over a multi-year period?
Right. The strategy of getting inside the facility first and figuring out how to squeeze the labor inefficiencies out later.
The concept, though, I want to emphasize it, is about optimization, not just squeezing. Well, they executed that exact same strategic playbook in the third quarter of the prior year, taking on this gargantuan TfL contract.
Okay.
If you think about what it takes to service the Transport for London network, the London Underground, the bus depots, the massive rail hubs, you're dealing with an extraordinarily complex logistics puzzle.
I can't even imagine.
You have militant labor unions, brutal night shift constraints, and just a sprawling, decaying physical infrastructure.
So it's a nightmare to manage.
Exactly.
Yeah.
And as ABM integrated the contract and began running the daily operations of the last few quarters, they ran the hard data and realized a deeply uncomfortable truth. The fundamental economics of the contract were permanently, irreparably misaligned with their long-term corporate margin targets. Whether it was unforeseen labor constraints, unmanageable logistics, or just a poorly structured initial bid, they realized they simply could not engineer a viable path to acceptable profitability.
So instead of clinging to the contract just to artificially prop up their top-line revenue growth metric, which, let's be brutally honest, 90% of public management teams would do simply to avoid spooking Wall Street algorithms with a revenue miss, they pulled the plug and walked away.
Yes.
That is astonishingly rare. To willingly sacrifice $70 million in revenue to protect the integrity of your overall margin profile is a wildly bullish signal regarding the company's internal return on invested capital, or ROIC, standards.
It really is.
It proves definitively that they are not interested in blind empire building. They are solely interested in mathematically profitable growth.
Yeah, it forces sophisticated institutional investors to view the entire management team through a completely different lens. You do not voluntarily shed a $70 million revenue stream unless you have supreme, mathematically backed confidence in your ability to deploy that freed up capital and, more importantly, that freed up management bandwidth somewhere else at a significantly higher rate of return.
Right, it's an opportunity cost calculation.
Exactly. And that logic perfectly connects us to where they are actually aggressively allocating their capital right now.
Let's transition into capital allocation then, which leads us directly into what I consider the single most compelling macroeconomic theme of this entire earnings breakdown: the artificial intelligence and semiconductor supercycle.
The big stuff.
But before we get to the massive M&A news, we have to establish the foundation of their capital allocation strategy, which is a dramatically improved free cash flow profile. They generated $48.9 million in pure free cash flow in Q1, which is a massive structural improvement over the prior year.
Yeah, and the primary engine driving that cash flow stabilization isn't just selling more services. It is the successful implementation of a massive enterprise-wide new enterprise resource planning, or ERP, system.
Oh, ERPs.
I know. Management noted they are finally in the 7th or 8th inning of this brutal integration process.
I want to pause on this because the term ERP integration usually puts retail investors to sleep.
It does.
But the actual mechanics of it are fascinating and dictate massive swings in cash flow. Walk us through how a software upgrade magically creates $48 million in free cash flow.
Well, it fundamentally rewrites the speed of money inside the corporation.
Okay, what do you mean by that?
Think about the nightmare of managing a 100,000-person blue-collar workforce using legacy fragmented systems. You have janitors in Des Moines punching physical time cards, electricians in Seattle logging hours on a bespoke app, and managers in Atlanta trying to reconcile all of it manually to generate an invoice.
That sounds like a disaster.
It's incredibly slow. A client might not get billed until 30 days after the service is rendered, and they might take another 60 days to pay. That is 90 days where ABM has paid its workers but hasn't collected the cash.
Which drains their working capital.
Exactly. A unified, cloud-based ERP system standardizes everything. A worker finishes a shift, logs it on a centralized mobile platform, and that data feeds instantly into an automated invoicing system that bills the client the next morning.
Boom!
By aggressively shrinking the days sales outstanding, or DSO metric, which is literally just the number of days it takes to collect cash, you instantly create tens of millions of dollars in free cash flow out of thin air simply by moving the money faster.
That makes so much sense when you explain it like that. And what did they do with that newly liberated cash? They aggressively went into the open market and repurchased 2.1 million of their own shares for $91.1 million during the quarter, buying at an average price of roughly $44.13. So they are easily covering any stock-based compensation dilution and then forcefully reducing the float. But the true headline event for their capital allocation strategy is the WGN Star acquisition.
Yes, this is massive.
This deal officially closed right at the beginning of Q2, so the actual financials aren't in the Q1 numbers we are dissecting today, but it completely, unequivocally dictates their forward trajectory.
Absolutely.
This acquisition is large enough that it will temporarily spike ABM's leverage ratio above their stated comfort target of 3.0x debt to EBITDA. But management is highly confident they can use that newly stabilized, ERP-driven free cash flow to rapidly delever back below 3.0x by the end of the calendar year.
And you know, the strategic value of the WGN Star asset just cannot be overstated here. We need to look at both the pure math and the strategic access.
Okay, let's look at the math first.
From a purely financial perspective, WGN Star brings an expected $120 to $130 million in full year 2026 revenue.
It's just nice.
But crucially, that revenue carries a double-digit organic growth profile and operates with incredibly lucrative EBITDA margins of approximately 15%.
15%.
Yeah, that 15% margin profile is massively higher than ABM's consolidated corporate average. But the real structural value is the sector access it grants them.
And this is exactly where we need to connect the micro details to the macro environment. Management cited a specific, massive forecast from PwC on the call, projecting over $1.5 trillion in global semiconductor fabrication investment by the year 2030.
$1.5 trillion. Let that sink in.
It's unbelievable. And this monumental deployment of capital is being driven almost entirely by the insatiable global demand for the advanced microchips required to power artificial intelligence, large language models, and cloud computing infrastructure.
Right. And WGN Star provides ABM with direct, immediate, deeply embedded access to this specific supercycle. WGN Star does not clean office buildings.
No, not at all.
No, they specialize entirely in providing hyper-specialized, highly technical maintenance and operational support services specifically for advanced chip fabrication facilities, which are universally known as fabs.
It is the ultimate expression of the picks and shovels investment theory.
Completely.
If you look at the market right now, retail investors and institutions alike are hyper-obsessed with the handful of tech giants designing the AI chips, or the hyperscalers spending billions to build the data centers.
Right. Everyone's chasing NVIDIA and Microsoft.
Exactly. The valuations on those pure-play tech stocks are bordering on astronomical. But here is ABM, a quote-unquote boring facilities management stock, quietly and methodically buying up the exclusive rights to mop the floors, maintain the complex HVAC filtration systems, and manage the highly sensitive clean rooms inside the multi-billion-dollar physical structures where these miraculous chips are actually manufactured.
Yeah, you really have to understand the physics of a semiconductor clean room to appreciate why this is so lucrative.
Talk about that.
Maintaining a modern semiconductor fab is the furthest thing imaginable from standard janitorial work. We are talking about facilities utilizing extreme ultraviolet or EUV lithography machines that cost $200 million apiece.
$200 million for one machine.
Yes. These machines utilize lasers to etch patterns onto silicon wafers at the atomic level. If a single microscopic particle of skin cells, or a tiny fluctuation in the ambient humidity, or a microscopic vibration from a poorly maintained air conditioning unit enters that environment,
The wafer is ruined.
it can ruin a batch of wafers worth millions of dollars in a second. The individuals WGN Star employs to maintain these rooms have to wear full-body, specialized bunny suits. They follow protocols that are more rigorous than a surgical operating room.
Wow.
The margin for error is absolute zero regarding particulate contamination. That intense technical requirement and the devastating financial consequences of failure for the client is exactly why the EBITDA margins for WGN Star are sitting comfortably in the 15% range.
They're pricing in the risk.
By integrating WGN Star, ABM is strategically, aggressively moving up the value chain. They are abandoning the commoditized reality of cleaning standard offices and transforming into a mission-critical operational partner in the single most vital, heavily capitalized manufacturing supply chain on the planet right now.
It fundamentally rewrites the narrative of what kind of company ABM is going to be in 5 years.
It really does.
But here is the inescapable reality. Whether you are emptying trash cans in a stadium, engineering a massive microgrid for a data center in Virginia, or carefully wiping down the airlocks in an EUV lithography clean room, you require human labor.
Yep, the human element is unavoidable.
And this brings us to the investor context segment, specifically focusing on what I consider the biggest macro surprise of the quarter, the resilience of their labor force.
Oh, this was wild. If you look at the current macroeconomic and geopolitical environment, the labor data that management provided on this call was genuinely stunning.
Set the stage for us. What's the macro picture look like right now?
Well, we are operating in an economic reality characterized by intense, polarizing immigration debates, general inflation stickiness that refuses to break, and a historically tight labor market where workers hold significant leverage.
Right.
So a massive blue-collar heavy employer like ABM trying to staff over 100,000 roles globally should theoretically be feeling an immense crushing squeeze on both the raw availability of workers and the cost of wages.
But the data says they aren't.
Not at all.
Management explicitly reported that they saw literally zero deterioration in applicant flow during the quarter, and they noted no major systemic wage pressure across their portfolio. I need you to reconcile this for me. How is that mathematically possible in the current U.S. economy?
It points to two distinct realities. First, the macro labor pool for this specific tier of service work might be significantly deeper and more resilient than the headline economic data suggests.
Okay, that's possible.
But secondly, and far more importantly for ABM's long-term competitive advantage, their internal capital investments are finally bearing fruit. Over the last 3 years, while competitors were just trying to survive, ABM poured massive amounts of capital into completely upgrading their talent acquisition technology stack.
Okay, break that down. What does a modern talent acquisition tech stack actually look like for a janitorial company? We aren't talking about recruiting software engineers at Google.
No, but the volume is staggering, which means the efficiency gains are massive. In the past, hiring for these roles involved physical help wanted signs, paper applications, and disjointed local managers trying to run manual background checks.
Sounds extremely tedious.
It took weeks to hire someone, and by that time they had found another job. But ABM has modernized this completely. They utilize programmatic job advertising that automatically adjusts spend based on localized applicant flow.
Oh, that's smart.
They use automated SMS text message screening to instantly engage an applicant the second they apply on their phone. They have integrated instantaneous background check APIs. They have compressed the time to hire from weeks down to days, or even hours.
Wow.
When you process human capital with that level of extreme efficiency, you mathematically insulate yourself from broader labor market friction. The fact that their labor supply remains robust and wage pressure is muted is a massive, highly underappreciated competitive moat.
I want to pivot the labor conversation slightly because whenever we talk about managing a massive physical workforce in the year 2026, the conversation inevitably, unavoidably turns to the threat of automation.
Oh, the robots.
Exactly. Everyone has seen the viral videos of humanoid robots doing backflips. If I'm an investor holding ABM for the next decade, I have to ask, will artificial intelligence and humanoid robots completely replace ABM's core workforce? Are we 5 years away from a fleet of robots autonomously cleaning the airport terminals while the human workforce is laid off?
This is the existential question for the sector, and management explicitly addressed it on the call. Their analysis was incredibly grounded and completely devoid of the usual Silicon Valley hype.
That's refreshing.
They are, of course, actively researching and testing advanced robotics, but they draw a very sharp, incredibly important technical distinction between structured tasks and dynamic environments.
Explain the difference.
A robot powered by current AI models can absolutely handle a perfectly structured task. If you place an autonomous floor scrubber at the end of a wide-open, perfectly empty, brilliantly lit hospital hallway, it will clean it flawlessly.
But I'm assuming most of ABM's revenue isn't generated in empty, perfectly structured hallways at 2 in the morning.
Exactly the opposite. Think about the chaotic environments where they actually operate and generate their massive revenue. Navigating a densely crowded airport terminal where thousands of unpredictable humans are rushing to gates with rolling luggage.
Oh, a robot would just freeze in an airport.
It would just stand there. Or cleaning a messy corporate office where employees have arranged their desks haphazardly, left cables across the floor, and spilled coffee in unpredictable patterns. Or managing the complex waste disposal logistics across a sprawling university campus during a snowstorm.
Yeah, good luck teaching a robot to do that anytime soon.
These are highly dynamic, endlessly unpredictable, unstructured environments that require intense human judgment, fine motor dexterity, and the real-time cognitive adaptability to instantly adjust to changing physical traffic patterns and unexpected compliance requirements.
Which AI just doesn't have.
Current robotics, despite the impressive videos, simply do not possess that level of generalized spatial intelligence and physical adaptability yet. And honestly, the battery density constraints alone make deploying humanoid robots for 8-hour shifts financially unviable currently.
So the thesis is that AI is absolutely not a disintermediation threat to their core boots-on-the-ground service model. Instead, it sounds like they are aggressively utilizing AI to optimize the unseen management layers operating above the physical labor.
Yes, that is the correct framework. They are deploying AI models for predictive maintenance. Instead of sending a technician to check an HVAC system every month, the AI monitors the vibration and energy draw of the unit and alerts the technician exactly when a bearing is about to fail, dispatching them before the system breaks.
Well, that's a huge cost saver.
Huge. They are using intelligent algorithmic scheduling and optimized back-office routing to ensure their human workforce is deployed as efficiently as physically possible across a crowded city grid.
Right.
AI is currently enhancing their margin profile by stripping out the bloat in SG&A selling, general and administrative expenses, and drastically improving localized labor efficiency. It is optimizing the business. It is not replacing the core physical product.
That is a critical, nuanced distinction for long-term investors evaluating the disruption risk to this stock. And speaking of long-term macro risks, we have to briefly touch on the prime office outlook.
Yeah, we can't ignore the offices.
The dominant financial narrative for the last 3 years has been that commercial real estate is completely dead, killed by remote work. Yet ABM's B&I segment, which is heavily exposed to offices, still managed to grow.
Right, and the key phrase to understand here is the flight to quality.
Ah, the flight to quality.
Management noted on the call that Class A office vacancy, the absolute premium, state-of-the-art skyscrapers with massive amenities, is actually stabilizing in major gateway markets like New York and Chicago. Institutional transaction volumes for these premium buildings are finally improving.
Because everyone wants the nicest office to lure workers back.
Exactly, and because ABM's client portfolio was meticulously curated to heavily skew toward premium, Class A assets and Fortune 1000 corporate clients, they're largely insulated from the apocalyptic financial distress, currently wiping out the owners of older Class B and C office spaces in secondary markets.
Right, the strip malls and the B-tier suburban parks.
The premium market has found its absolute floor, and that protects ABM's baseline revenue.
Let's bring all of these complex threads together and look at the forward guidance and the path forward for the rest of the year. Despite the massive $20 million pothole in the ATS segment, despite the looming geopolitical uncertainties, and despite shedding the $70 million TfL contract, management's full-year 2026 financial outlook remains completely aggressively unchanged.
Which is pretty bold.
It is. They are still guiding the market to expect 3% to 4% organic growth. And when you factor in the incoming revenue from the WGN Star acquisition, that pushes total growth to the 4% to 5% range. Crucially, they are rigorously maintaining their adjusted EPS guidance of $3.85 to $4.15 for the full year.
What I found particularly aggressive and frankly a bit brazen is that management strongly hinted during the Q&A session that their internal financial models are currently tracking toward the higher end of that EPS range.
Even with all this macro uncertainty.
Yep, despite openly acknowledging the severe macro uncertainties facing the broader economy.
I'm going to return to my earlier skepticism because it is the only way to evaluate the stock. To believe the high end of that guidance range, you as an investor have to fundamentally, unequivocally believe in the second half ATS margin snapback.
You really do.
You have to believe that the winter weather delays were truly, purely transient. You have to believe that the $20 million in suspended microgrid projects will flawlessly come back online without cost overruns. And you have to believe that the historical 350 basis point margin improvement they usually see in the second half will materialize perfectly despite the tight labor market. That is a massive operational parlay.
You have correctly identified the absolute crux of the investment debate right now. It is a fundamental bet on management's clear visibility into their own project backlog versus the chaotic, unpredictable nature of macroeconomic execution.
High risk, high reward.
If they hit the snapback, the stock is deeply undervalued. If they miss it, the market will punish them brutally for maintaining guidance they couldn't hit.
Which perfectly, seamlessly sets up our final segment. It is time for This Is Not Financial Advice.
Oh, here we go.
I want you to step away from the objective analysis, put on your most aggressive hedge fund portfolio manager hat, and walk into the investment committee meeting. Pitch me an outrageous but plausible, highly structured trade idea based on all the macro and micro signals we have unpacked over the last hour.
All right. Keeping in mind, this is purely a theoretical exercise in financial structuring. Let's call this the picks, shovels, and mops pair trade.
Okay, I love the name. Let's hear the thesis.
The core thesis driving this trade is that the broader equity market is entirely fundamentally mispricing ABM Industries due to a failure of categorization. The algorithmic market looks at the ticker symbol for ABM and immediately categorizes it as a legacy, low-growth janitorial stock intrinsically tied to a stagnant, dying commercial real estate sector.
Which, as we've discussed, is just factually wrong.
It is completely ignoring the reality that, through the WGN Star acquisition and the explosive underlying organic growth in their ATS microgrid segment, ABM is rapidly transforming its corporate DNA. It is becoming a high-margin, mission-critical infrastructure play directly levered to the $1.5 trillion semiconductor and AI supercycle.
I follow the logic on the mispricing. So what are the actual mechanics of the long leg of this trade? How are you executing the upside?
You go disproportionately long on ABM Industries, but you do not buy the common equity.
Okay, what are you buying?
You utilize long-dated call options, we're talking LABS, specifically aiming for expiries 18 to 24 months out. You use the options to maximize your leverage on a structural multiple expansion. Right now, ABM trades at a multiple, that's fitting a commercial cleaner. As the institutional market slowly wakes up over the next 4 quarters to the fact that ABM is the sole entity maintaining the physical integrity of advanced AI data centers and EUV semiconductor clean rooms, their price-to-earnings multiple should structurally violently re-rate higher. They should begin trading closer to the multiple of a specialized industrial tech services company.
That would be a massive re-rating.
Massive. The long-dated calls give that narrative time to penetrate the market consciousness and allow you to capture massive upside leverage as the multiple expands.
Okay, the long thesis is sound, but you are still holding massive, undeniable exposure to the commercial real estate drag hidden inside their legacy B&I segment. If the broader economy tips into a severe recession and the Class A office market cracks, your ABM calls are going to get slaughtered alongside the rest of the market. How do you financially neutralize that macro real estate beta?
That is where the short leg comes in to fund the trade. You fund the premium required for the long ADM option position by aggressively shorting a highly targeted, meticulously screened basket of legacy, pure-play commercial real estate REITs.
Oh, nice. But which ones?
You do not short premium Class A REITs. You specifically screen for regional REITs that are heavily over-indexed to Class B and C office spaces located entirely in secondary non-gateway markets.
The truly doomed assets.
Exactly. These are the exact physical properties that are fundamentally distressed, suffocating under high interest rates, and entirely lack the flight to quality dynamics that ABM's premium client portfolio actively enjoys. You short the dying assets to fund your long position in the AI infrastructure assets.
So you are surgically isolating and capturing ABM's specific operational alpha in the high-growth tech and aviation sectors, while completely neutralizing the macro real estate drag. It's a beautiful pair trade, but there is a massive hole in this strategy.
Let's hear it.
What about the ATS pothole we spent 20 minutes debating? What happens if they miss the second half margin snapback?
You are absolutely right. You have to hedge the specific idiosyncratic risk. The primary stated risk to ABM hitting that high-end guidance and triggering your multiple expansion is another massive unseasonal weather event actively delaying the crucial second half ATS revenue recognition all over again.
So how do you hedge the weather?
So you overlay the entire pair trade with a highly specialized weather derivative. The financial markets offer instruments for this. You buy out of the money, put options on an extreme weather or hurricane index specifically targeted the U.S. East Coast and the Mid-Atlantic, where a massive concentration of their data center microgrid work is located, heading into the third and fourth fiscal quarters.
That's brilliant.
If a massive catastrophic storm system hits Data Center Alley in Virginia, stalling construction and wrecking ABM's ATS revenue recognition for a second time, your weather derivative pays out massively, completely hedging the downside risk on your long ABM calls.
That is an incredibly intricate, flawlessly structured pitch. You isolate the AI and tech growth through LaPiece, you fund it by shorting the worst of the dying commercial real estate market, and you literally buy insurance against the weather to protect the specific margin vulnerabilities of their technical segment. A phenomenal pitch for the committee.
Thank you.
And with that complex architecture in mind, let's rapidly recap the massive amount of ground we've covered today. We tore into their stellar 5.5% organic growth, driven by massive structural tailwinds in aviation infrastructure and tech sector wins.
We examined the brilliant strategic shift up the value chain via the WGN Star acquisition, granting them direct access to the highly lucrative, high-margin semiconductor fabrication cleanroom space.
We heavily debated the mechanics of a temporary, weather-driven margin collapse in their technical solutions segment, exposing the brutal reality of sticky costs regarding highly skilled technical labor.
And we analyzed a surprisingly robust talent acquisition machine that is utilizing AI to optimize scheduling rather than threatening to replace the physical workforce with humanoid robots.
The sheer density of macroeconomic information contained within a single quarter of a seemingly boring facilities management company is why you have to relentlessly look beyond the surface-level classifications of any business.
You really do. It's all connected.
And now we want to invite you, the listener, to weigh in on the debate. Do you genuinely believe management's absolute confidence that the ATS margin collapse is purely a transient, weather-driven timing delay that will flawlessly snap back in the second half of the year? Or do you agree with my skepticism, viewing this as a glaring warning sign of much deeper structural execution risks creeping into their single highest growth segment?
And as always, a final reminder that the complex trade structures, weather derivatives, and options strategies discussed today are purely theoretical exercises designed strictly for educational purposes and absolutely do not constitute financial advice.
Thank you for joining us for this incredibly detailed earnings breakdown on this deep dive. We will leave you with this final, lingering thought to mull over as you analyze your own portfolios in a market utterly obsessed with the flashy software, the AI models, and the theoretical capabilities of tomorrow's technology. It is very often the businesses operating quietly in the background that are the real winners.
The companies physically maintaining the HVAC systems, securely routing the power to the data centers, and meticulously mopping the dust out of the semiconductor clean rooms.
Exactly. They're the ones quietly, inevitably powering and massively profiting from the most exciting technological revolutions of our time. Keep your eyes firmly fixed on the physical infrastructure.